to the End of the Day show. I'm your host, Mike Parker. Excited to be back with you all. It is Tuesday, September 10th. So we are post Labor Day. Things get very busy around this time of the year with events. Lots of industry things happening. I was actually at a dinner last night. Today, Acquired, which is a very popular business podcast. They're having a live event at the Chase Center here in San Francisco. So I'm heading over to that, and there are multiple events happening all over the country right now as it relates to tech, entrepreneurship, and business. So it's a very exciting time. But I wanted to talk about one of the main topics we always talk about on this show, the current state of fundraising. So I want to recap some key strategies for founders that are looking to raise capital in this tough market. I was at an event last night with one of my first investors in my first company when I moved out here to the Bay. And it was really interesting for me to be at that event because it kind of looked in hindsight at the past 5 years or so of the way the venture market has changed. So I'll unpack that and just take a look at how the framework and how I'm thinking about the current fundraising market in the venture space, key strategies that founders can apply and try to improve their chances. And lastly, I will close with a little bit of a VC drama beef segment where we see Paul Graham and David Sachs. Paul Graham, notorious for starting Y Combinator. David Sachs, now most notorious for the All In podcast, which has become the biggest tech media platform in the world, I think, in the past couple years. And they're actually hosting the All In Summit down in LA this week, but a little bit of shots thrown on last week's episode that I'll get into. So let's get right into the show. So first topic, spent some time at a dinner last night, and the theme was fundraising. It was all founders, people who had raised anywhere from a couple $100,000 in a pre-seed family fund or family and friends accelerator round, all the way up to someone who just closed a $30 million Series B that only took him 2 weeks. So there was a very broad range of founders in the room, probably like 60 or so founders. One of the most active seed capital investors, Right Side Capital Management, hosted it, and they are well known for investing in a high volume. I mean, they probably are maybe outside of your Y Combinators and your accelerator programs, they're probably the most active pre-seed investor in the country. They do about 50 deals a year. So they have a lot of data, a lot of insights and points on the fundraising market. So what was really the key theme of this story is that the market right now is quite different than it was even a year ago, even much more than that, 2 years ago, 3 years ago, 4 years ago. Today, the challenges are a bit different. So the selectivity that investors are, taking now is really at an all-time high, right? Most investors, in 2021, when I raised the bridge round of financing, it felt like there were more investors than there were companies. Now in 2024, it feels like there's substantially more companies and less investors. So generally what's happening is investors are able to be much more diligent unless it's a super hot AI deal with a team that's just well known. It's a much longer process. Also, rounds take longer to close, right? So the endurance you have to have as a founder when you're going through a fundraise right now is probably at an all-time high. Many founders are just burning out and either quitting or just trying to fire sale their company or just not focusing on fundraising, which is also very probable if you have some form of profitability and you have some form of growth where you don't need to raise. Valuations are much lower. I mean, you see companies that in 2021 might have raised at $100 million. If they haven't made a lot of progress in 3 years, they're probably raising it like, if they can raise, much less than that. Sometimes even close to 10, 20 million on companies that were valued at $100 million almost 3 years ago. There's also a greater emphasis on capital efficiency. I think that's the biggest thing I've learned from all this, both personally and from a business perspective. The money that you have access to, whether you raise it, whether you make it through revenue, however you get it, you have to be smart in how you utilize it. Take a quick break, but I'm back. And Where was that? Well, the valuations are generally lower. There's also just this greater emphasis on capital efficiency, which I think that's been the best thing that's happened, at least for me. Now I don't have all the money in the world, but at the end of the day, you do have a more, higher value for a dollar than we did in the ZERP era. Understanding that you need to make things stretch much longer. And I have a very controversial view on when you do raise venture capital, you should target only spending about 10% of what you raise over the first 18 months post raise, which I was actually talking to one of my founder friends about this, and he says that's just unrealistic. The VC wants you to spend the money. But when we really got into the weeds, and his company, unfortunately, they didn't have a great exit, but he did, mention it's like it was pretty crazy that we were spending $200,000 to $300,000 a month, really without any incremental revenue, because we honestly just thought we'd be able to raise more money after our seed round. And so many founders think like that. You get that first tranche of funding, whether it's $500,000, $1 million, $2 million, $3 million, 10, 20, and you prospectively think that, oh, wow, I can do this again. And what we've learned now in 2024, there's more companies on the market. There's less venture capital. There's more scrutiny around the rounds, and there's just money just isn't there, right? It's just hard to access it from fundraising. And fundraising is also this like crazy psychological thing, because to go out and generate $1 million in revenue, that's really hard, right? It's not, most businesses never get to that point. To go raise 3, 4, 5 million in venture capital, historically, although it's not easy, it's much easier to do that than to go make $1 million in revenue. So I think a lot of times founders forget that, the money can go way faster than you can bring it in, particularly when you're, early in building out your company. So this shift is really happening. It's here, right? And I think many founders are going to be smarter now about how they approach it. So getting into some strategies, right? Got about 8 quick strategies that I think that I took from this conversation that I'm going to apply. Is prepare for a long fundraising cycle. Expect the process can take 4 to 6 months. I typically say 60 to 90 days, because you should be very much dialed in when you start your fundraising process. But if you aren't, it could take you longer. But I do think you should optimize for a 60 to 90 day process. You should allow time for due diligence, but you should already have everything pre-groomed, pre-ready to go, meaning your due diligence room, all of your documents, everything that a venture capitalist or an investor would want to see, have that ready to go. They advise having 6 to 9 months of runway when you start to raise. Obviously, that's ideal, but I would say you would want to buffer 3 to 6 months for sure, because at the end of the day, you want to have a sense of urgency with your fundraise. And it's honest that a lot of companies almost have these near-death experiences. So if you got 6 to 9 months of capital in the bank or more, your fundraising process is not going to be very tight, and it's not going to be very process-driven, and you might not be successful. So having, obviously maybe if you can raise on an ongoing basis is better, but at the end of the day, you want to be able to get through that fundraising process. Obviously, metrics-wise, if the investor is judging you on your metrics, right, they need to be great, right? They're looking for strong, sustainable growth. You should be aiming for 2 to 3% year-over-year growth, minimum 10% growth in your company from a revenue perspective, which is not easy to do either, right? It's not easy to get to $1 million. It's not easy to grow 10% month over month. So it is always important to focus on those hard things first. You should also be demonstrating an efficient use of the capital. I like the 1 in 10 model, right? Every dollar you bring in venture, only spend 10% in an 18-month time frame, which forces you to grow revenue, which forces you to figure out how your business is going to actually generate income. Number 3, cast a wide net. One of the more interesting conversations that was had in this talk was a founder who just did his Series B in 2 weeks. He raised $30 million, but he mentioned that in his Series A, he did over 200 meetings. He was doing over 200 meetings per month, right? He was doing almost at one point 100 meetings a week, right, to get to that round. So at the end of the day, he did, he broke it down to where he was doing hundreds of meetings every couple of weeks. He forced himself to hold himself to a a minimum amount of meetings that he was going to get. And these are first meetings that he's having with the venture capitalists. He relayed that back to his staff to keep him accountable. But you should be aiming for, I think great founders get 30 to 40% conversion rate. So for every 100 investors that you get introduced to or you reach out to, your best fundraisers are going to go get 30 to 40 meetings. And then the average is probably right now, from this conversation, could be below 10%. So you need to really, really mass up your volume. Number 4, create urgency and momentum. You're right. Get the smaller checks, right, from the angels, the micro VCs. Again, I predominantly like to stay away from friends and family because friends and family doesn't necessarily understand how venture capital works, knowing that there's a 95% chance that you might fail. But smaller checks from angels and micro VCs is useful. Use early commitments to create that FOMO. So get early commitments on the board, get wins on the board, just like any other process. That's a really important thing. And then, they were talking about other ways you can raise in tranches to increase your valuation. It's really just a sales funnel. Fundraising is a sales funnel. Number 5, perfect your pitch and materials. At this particular audience, they were telling us to target 10 slides or less, but putting all of your most impactful high value items in those first 3 slides, right? So everything that's great about you want to have in those first 2 to 3 slides. There was even recommendations to only do a 2 to 3 slide teaser that has the most valuable real thing that's happening for your business in that first pitch, because most venture capitalists or most people you're investing, they're not going to look past the 3 slides. Also, you could tailor your message to their interest and their thesis. So you could do the 3-slide model, and then you could do a unique 3 slides for each investor that you're sending out a pitch to. That doesn't take you that much time when you think about what we could do with AI and customization. So you honestly want to be able to have very, very strong conversions to get that first meeting. Number 3, be persistent and follow up. Right, this is one of my biggest pet peeves. Something that I've failed at in the past is just not being as persistent with the follow-up game as I can be. Right, don't be afraid to be annoying, particularly when it comes to raising money. Right, you can get commitments, and these things can fall through the cracks. You got to be on top of it. You can't expect them to chase you down because if you're in the 1% that get chased down by investors, you're in a whole different ball game anyway. But if you're in the position where you actually have to sell your story, sell your vision to get capital, you have to be on top of it and you have to be persistent. They also mentioned number 7, consider alternative funding sources. Right, once you have revenue, there's a growing amount of revenue-based financing options. There's obviously venture debt, which some people don't like, and then there's also government grants and industry-specific programming. If you want to know more about that, I do a fundraising course. I'm actually having a free 30-minute session this Saturday. So that link will be right here. Lastly, manage your burn rate carefully. Like that was the biggest theme, is like this 10% thing that I believe in is really what's going to, I think, help a lot of companies exist longer when we don't know what's happening in the market. So those are all the things. If you'd like to get access to this deck, I can share it with you. Just send me an email, matt@stretch4.co. Happy to share with you the deck that they actually presented. I think it's great for founders. But yeah, that was kind of the high level of this event. Moving into some more interesting, entertaining stuff, we shift gears and talk about some drama at the top of the venture capital world, right? There was a recent Reddit post that highlighted a growing rift that's continuing to boil up between Paul Graham, co-founder and CEO or co-founder of Y Combinator, and David Sachs, the co-founder of Craft Venture and one of the 4 hosts of the All In podcast. This spat seems to have its roots in a disagreement over the Zenefit CEO. So I mentioned this on a show previously. Parker Conrad, who is now the CEO of Rippling, which is a $13 billion HR company. Formerly, he was the CEO of Zenefit, which reached a $4 billion valuation and ended up going to zero. David Sachs came in and took over that company. He was an early investor. He took over that company after Parker had some issues. So the drama came to light in the latest episode of the All In podcast, where Sachs and his co-host Chamath Palihapitiya discussed Paul Graham's controversial essay, Founder Mode, which Founder Mode, if you don't know what that is, just Google it, but it's been the most talked about subject in San Francisco, Silicon Valley, tech in the past 2 weeks. Sachs made some very thinly veiled jabs at Graham, and I caught these. My wife, me and her listen to this show every week, but like I'm more into like the kind of like I like to see the science and right the science of how these guys are kind of manipulating and talking to different people and presenting different positions. But this was very interesting because Sachs made these comments about Graham, and he sarcastically referred to him as this unicorn whisperer, pointing out that Graham himself has never created a unicorn, which was an interesting point because I kind of feel from my perspective as a founder that's kind of been outside of the Y Combinator mafia, so to speak, I do think there is a lot of, clout culty kind of vibes in within the Y Combinator organization, right? The way they kind of like have, they've been successful in what they do, but a lot of times their whole mindset is to like shit on people outside of their spectrum, right? If you're not in the Y Combinator mafia, you're kind of like outside and you don't know, and it kind of can be very weird. But Sachs has, calls him a unicorn whisperer, pointing out that Graham has never created a unicorn. Some of the people thought this was off because they said that Brian Chesky was actually the one who made this famous, and he's been, been very adamant, showing and taking credit for it. And he built Airbnb, which is a $70+ billion company. Y Combinator, under Graham's guidance, has produced numerous unicorns and widely is regarded as the gold standard for seed investors. So people are saying basically Sachs can't really, talk on Paul Graham for not creating a unicorn because in itself, Y Combinator has created multiple unicorns, right? And it does seem like David Sachs and Chamath have a little bit of beef towards Y Combinator. I know back in the day, Jason Calacanis, who's also on the show, he used to talk about Y Combinator kind of keeping him out of the demo days or wouldn't let him go to the demo days. Maybe there's some of that going on with David Sachs and Chamath because it is a very interesting organization how Y Combinator works because like essentially Paul Graham, once he kind of anoints you as like good, you kind of can become a different level of successful, right? If you think about Sam Altman now with OpenAI, Paul Graham anointed this kid or this guy who's now 40 at 19. He basically was like, this is one of the smartest. This is going to be one of the most successful entrepreneurs. And it's like Sam Altman has kind of lived that, lived that reality to an extent. He's also anointed Gary Tan, who became the president and CEO most recently. So it's kind of like this process of like, Paul Graham kind of plays this Jesus God role within the Y Combinator ecosystem. And so it is interesting, which I respect from Sachs and Chamath. They're kind of taking shots at him like, hey, he's just like anybody else, right? He hasn't really built this unicorn himself. He's just kind of a unicorn whisperer. He writes all these articles and these essays and these blogs and makes people think that his way is the way. But at the end of the day, he hasn't even done, what he says, what he talks about. Kind of like the NBA analogy when you get like a lot of ex-NBA players critiquing Stephen A. Smith or any of the other, any of the other talking heads that never really played the game at their level. It's kind of what they're taking with him. They're like, hey, like Chamath, he worked at Facebook in the heightened days of Facebook when it was being built and became a billionaire. David Sachs created a unicorn, sold a company for $1 billion. So it's like they're kind of taking the approach of like, Paul Graham talks all this talk, but he's never actually, created $1 billion company. The Reddit discussion goes on to point out that Sachs and Palihapitiya may be successful in their own right, which they are, which I think that's the other piece of this is that All In is the most successful media platform in tech, right? Based on numbers, based on a lot of things. So it's like Y Combinator has also become very, very active in media. If you think about it, Gary Tan, before he became CEO, he became almost like a full-time YouTuber. He was creating YouTubes. He was, he had a producer. He had this high-end production. And now you see Y Combinator, they have so much YouTube content. They pump out a lot of content over there. So I think a little bit of this is, and Paul Graham as well, because he writes these essays. It's kind of like Sachs and Chamath are like, hey, like we're the biggest thing smoking in media. We're the tech media gods right now. Like whatever Paul Graham is talking about, right? They can't, they're not on our level, right? We have the political voice of Silicon Valley, right? David Saxon Chamath hosted Trump, raised $12 million. We got Elon, who's like best buddies with Elon. They just sold out a $7,500 ticket conference in LA. They bring in Elon Musk. They bring in Peter Thiel. They have all the top names in tech, in politics, in business that come on their platform. So they're like, hey, we're an independent media company and we have more pull and sway than Y Combinator, who is kind of like this, has built themselves to be the voice of all reason in Silicon Valley. So there's a little bit of beef there as well when you really get into the science of the media, who has more power, who has more impact, right? The political stuff, because, PG has said some very, what people would call made some very questionable political comments as it relates to Israel and Palestine. So there's a lot of intertwining conversations here. And so, it's very interesting to see, but as a founder, it's crucial to be aware of the dynamics that's happening right now. You can be blackballed from certain opportunities by siding with certain people in certain rooms, right? It's not a meritocracy like I think Silicon Valley has always presented itself. So very interesting stuff going on in the net. I will try to keep track of as much of it as I can, but thanks a lot for listening to the end of the day show. If you're out fundraising, again, I'm having a free webinar on Saturday. More information will be in the show notes. Check me out there on Maven. I also have a course that starts on September 19th on Maven, where we're going to go through the 60 to 90 day process, which is the process I prefer when it comes to fundraising. We'll go through all the details there. We'll go through some lists. We'll go through some hacks to get those meetings started. But again, stay persistent. If you're out there and you really like this show, hit like, subscribe, comment, and tell a friend about the End of the Day show, which we try to get out to you 4 times a week. That's all for today.